Ever wondered why your investments aren't yielding the expected returns? Perhaps you're not alone in this boat. You see, the world of investments is like a complex labyrinth. It's filled with opportunities, but also rife with pitfalls. And these pitfalls, or common investment mistakes, can be the very thing standing between you and your financial goals. Let's consider the case of John Doe, a once promising investor who suffered significant losses. John's downfall? A lack of a clear investment strategy. He jumped in headfirst, without considering the potential risks or the importance of diversification. His story serves as a stark reminder of the perils of investing without a roadmap. Understanding these common investment mistakes is crucial. It's about more than just knowing what to do. It's about knowing what not to do. It's about learning from others' mistakes to sidestep potential losses. Remember, in the world of investment, knowledge is power. Knowing what to avoid can be the difference between success and failure in the world of investment. The first common mistake is jumping in without doing enough research. This is like diving into a pool without knowing how deep it is. Risky, to say the least. Thorough research is the life jacket that keeps you afloat in the vast ocean of investment. Let's consider the story of Jake, an eager investor. Jake heard about a tech startup that was making waves in the industry. He was excited about the potential returns and decided to invest a significant chunk of his savings. However, Jake didn't dig deep enough. He didn't consider the company's financial health, its market position, or the competitive landscape. He was swayed by the buzz and the hype, but he didn't understand the business model or the risks involved. Jake's investment was akin to a blind bet. And as luck would have it, the startup's growth stalled, and they ran into financial difficulties. Jake saw his investment shrink, then vanish. He was left with a fraction of his initial investment and a valuable lesson on the importance of research. Research isn't just about reading the latest news or jumping on the bandwagon when a company's stock price is rising. It's about understanding the company's financial health, its earnings, its debt levels, and its cash flow. It's about knowing the company's business model, its products or services, its target market, and its competition. It's about being aware of broader market trends and economic factors that could impact the company's performance. Think of research as your due diligence. It's your way of assessing the potential risks and rewards of an investment. It's your way of making an informed decision rather than a blind bet. Research can be time-consuming, and it can seem complex, especially for new investors. But there are plenty of resources out there to help you, from financial news websites and investment blogs to analyst reports and company financial statements. You don't have to be a financial expert to do your research. You just have to be willing to put in the time and effort. Remember, ignorance is not bliss when it comes to investing. It's a potential pitfall that could cost you dearly. So before you dive in, do your research. It could make the difference between a successful investment and a costly mistake. Overconfidence can lead to downfall. This is especially true in investing. Let's delve into this concept a little deeper. Overconfidence bias, as it's known in behavioral finance, is a cognitive bias that can cause an investor to overestimate their knowledge and abilities, often leading to disastrous financial decisions. Imagine this. You have a friend. Let's call him John. John has had a few wins in the stock market. He's feeling invincible, like he's got the Midas touch. He begins to believe he has this uncanny ability to predict market trends, to foresee the ups and downs. This newfound confidence spurs him on to make riskier investments, ones that promise high returns. But here's where it gets tricky. The market is a complex beast, influenced by a myriad of factors, many of which are beyond human control or prediction. So when the market takes a turn for the worse, John's investments tank. His overconfidence, his belief in his own infallibility, leads him to financial ruin. Now, this is not to say that confidence is a bad thing. Far from it. Confidence can be a powerful motivator, a driving force. But overconfidence, that's a different story. Overconfidence can cause us to ignore warning signs, to dismiss advice, to take unnecessary risks. It can make us believe we are immune to the pitfalls that others fall into. But as John's story illustrates, no one is immune. So how do we guard against overconfidence bias? The key is self-awareness. Recognize that you are susceptible to this bias. Remember that past success does not guarantee future success. Keep learning, keep asking questions, keep seeking advice, and most importantly, stay humble. No one knows everything, not even the most successful investors. Investing is a journey filled with highs and lows, victories and defeats, but it's a journey worth taking, so take it wisely. Don't let overconfidence cloud your judgment. As the old saying goes, pride comes before a fall. So let's remember to check our egos at the door, to be open to learning, to be open to the possibility of being wrong. Overconfidence can cloud judgment. Stay grounded. Scene script. Ever jumped on a trend only to regret it later? This happens in investments too. You see, the allure of following the crowd is hard to resist. It's human nature to feel secure in numbers, to believe that there's safety in following what everyone else is doing. But in the world of investments, this can lead to disastrous financial outcomes. Let's examine the case of John, an investor who decided to ride the wave of a popular yet highly volatile cryptocurrency. John heard about this investment opportunity from friends, colleagues, and even the media. It seemed like everyone was buying this cryptocurrency and making a fortune. So, without much thought or research, John decided to put a significant chunk of his savings into it. Unfortunately, John's decision was not based on his personal financial goals or risk appetite. He was merely following the crowd, caught up in the hype. He didn't consider the volatile nature of the cryptocurrency market and how this risk might not align with his financial objectives. As it happened, the value of the cryptocurrency plummeted soon after John invested, and he faced significant financial loss. This is a classic example of the pitfalls of following the crowd. John was swayed by the popularity of the investment without considering if it was the right fit for his financial situation. You see, investment decisions should not be influenced by what's trending or popular. They should be based on careful research, understanding of the market, and most importantly, alignment with your personal financial goals and risk tolerance. Remember, what works for others may not work for you. An investment that suits your friend's financial goals and risk appetite may not suit yours. Investment is a personal journey, and every investor has unique goals and risk tolerances. So, the next time you hear about a popular investment trend, stop and think. Ask yourself, does this align with my financial goals? Can I tolerate the risk? Am I prepared to lose the money I invest? Investment is not a one-size-fits-all game. Always consider your personal financial goals. Now that we know what to avoid, let's talk about what to do. Successful investing is not a one-size-fits-all approach. It's about finding a strategy that aligns with your financial goals and risk tolerance. So, what are some strategies that have proven successful over time? First, let's revisit the importance of research. The more you know about a company or asset, the better positioned you are to make informed decisions. This means digging deep into financial statements, understanding the industry, and keeping up with current events that could impact your investments. But remember, it's not just about knowing the most. It's about knowing the right things. Next, let's talk about diversification. This is a strategy that involves spreading your investments across various asset classes to reduce risk. Imagine it as not putting all your eggs in one basket. If one investment doesn't perform as expected, others may help offset the loss. A diversified portfolio might include a mix of stocks, bonds, real estate, and even alternative investments. Avoiding overconfidence is also crucial. Overconfidence can lead to impulsive decisions and unnecessary risk-taking. Instead, adopt a humble mindset, acknowledge the unpredictability of the market, and make decisions based on careful analysis rather than gut feelings or speculation. Lastly, consider your personal financial goals. Are you investing for long-term growth, or are you seeking regular income? Your goals will dictate your investment strategy. For instance, if you're looking for long-term growth, you might lean towards stocks. But if you need regular income, bonds or dividend-paying stocks might be a better fit. Remember, the best investment strategy is one that fits your individual needs and circumstances. It's not about chasing the latest trend or making a quick buck. It's about building wealth over time and achieving your financial goals. Investing is a journey, not a sprint. Avoid these common mistakes, and you'll be well on your way to financial success.